Please take a moment to pause this video and read in full this important disclaimer. This demonstration is for educational purposes only and should not be interpreted as a recommendation to buy or sell a security. Decisions to buy, sell, hold, or trade in securities, commodities, and other investments involves risk of loss and should be taken in conjunction with a qualified financial professional. So the long call butterfly strategy, as I mentioned before, is a combination of this bull call spread and a bear call spread, where the trader looks to take advantage of a drop in volatility, time decay, and little or no movement in the underlying security. Now it has 4 calls, 2 short calls at the same strike price, 1 long call at a strike above the short calls, and 1 long call at a strike below the short calls. And all calls have the same expiration date. So essentially what we have here is a short straddle with long call protection above and below our short strike. Let's take a look at a good example. This is a trade setup for Federal Express that was based on those minor adjustments made to our long butterfly screener described in the webinar. The values are from the closing range on Tuesday, December 14th, with our December monthly options that have 3 days to expiration. Those color boxes that I've pointed out to you are our areas of support and resistance based on significant swing or recent pivot highs and lows. Now notice these areas are equal distance from our current price, 230 to 240 and 250 to 240. The bull call spread consists of the long call strike 230, which is going to cost us $14.10, and a short call strike 240, which will allow us to collect $7.85. The bear call spread consists of the short call strike 240, which we're going to collect $7.85, and the long call strike of 250, which is going to cost us $4. If we put this together, the 2 longs are going to cost us $14.10 and $4, which is a total of $18.10. The 2 shorts are going to allow us to collect $7.85 times 2, or $15.70. So the maximum loss, or my net cost, is $2.40. Our maximum profit is going to be the wing differential, $10, minus our costs, $2.40. And so our maximum profit will be $7.60. This is exactly what we want to be looking for: a limited amount of risk versus a greater return. In this case, about 3 to 1. Our break-evens are represented by the red lines. Our wings, plus or minus, our debit or our cost. So 230 strike plus the $2.40 cost inside of our wing, our break-even will be $232.40. Our 250 strike minus our cost, again, inside our wing, $247.60. As long as price remains between these 2 values, our butterfly will make a profit. Not the maximum profit, but somewhat less. Now notice I've added 2 other stats in the upper right-hand corner. Our 1-month implied volatility, 36.95, and our 20-day historic, 28.4. We want to choose those butterflies whose implied volatility is greater than the historical, in that belief that our butterfly, the price, is going to land on our middle strike. And thereby, the implied volatility will return to the historical and benefit our strategy. The third statistic is the 20-day average, average true range. Now, average true range is a measurement of volatility. It's based on 2 standard deviations. So 95% of all price action will fall inside of 2 standard deviations. So the 5.40 tells us there's a 95% chance price will remain inside of a range of $5.40. Now notice that value, $5.40, is inside of our wing differential of $10. That's a good thing, right? Over the next 3 days, if price doesn't have a 2 standard deviation event, our trade will be profitable. But notice that $5.40 is also inside of our break even as well. Another good thing to look for. But let's flip this around. Let's pretend that our average true range is 10 and our wing differential was 5. Then there would be a greater probability the price would move outside of our wings. So we want to find those trades where our average true range are inside of our differential. Now that could be a value that is close to or equal to, but we still would like to find it inside. In this case, it's about half of our differential. This is a good example of a potentially profitable long butterfly. I hope this video was informative. If you enjoyed today's content, make sure you subscribe to Bar Chart's YouTube channel and give the video a thumbs up. Until next time, the good of all trading.